I'm David Thal. The title of my talk is Intra-Family Loans, Efficient, Simple, and Powerful Estate Planning Tools. So to introduce the topic, interest rates remain at historic lows. They're expected to rise. The thesis of this discussion really is that families should be using intra-family loans to transfer wealth. To take an example, assume that I loan you money at a 2% interest rate for 9 years. You earn more than the 2% rate that I'm charging you. You pay me back interest at 2% and repay the principal at the end of 9 years. You get to keep the appreciation on that loan. And that right there is a very efficient, simple wealth transfer technique. So if you want to take this one step further, imagine that when I make the loan to you, instead of just buying public securities, you use the loan proceeds to purchase discounted assets. Assuming a 25 or 30% discount, you're already essentially locking in an enormous amount of potential upside. And again, that makes it a powerful technique. If you make this loan to a Grantor trust, and the Grantor trust purchases assets, not only are you getting all of the appreciation and upside on this discounted purchase, but I'm also paying your income taxes for you. And that is a tax-free additional gift to the trust. So again, it's a simple, efficient, powerful technique, and one of the most important things in the estate planning toolbox. When we talk about loans with clients, we also like to explore alternatives. And here we have some of those. Sometimes loans are not the right strategy. Gifts can be more simple. So in some circumstances, you may just want to have your client make a gift. Grats and private annuities can accomplish many of the same economic benefits for your clients, and those may be right in different circumstances. There are also variations on loans that can help your clients achieve different goals as well. So something may start out as a loan, and then your client may choose to make a loan forgiveness gift. So let's just take a minute to look at the rates. You have about 6 hours to avail yourself of the November rates that are listed on this page. For December, the rates are going up. So you have a short-term rate of 1.52%, mid-term rate of 2.11%, and a long-term rate of 2.64%, with the 75/20 rate at 2.6%. These rates are 50% lower than they were a decade ago. So still an opportune time to use loans to lock in these low interest rates, even though they've climbed a bit higher in the last 2 years. On the next slide, we just list here a couple of the most common strategies that clients, where we see clients using loans. There's almost an infinite number of uses for loans in the intra-family context. But maybe because of what's happening in the Senate today, let's skip to the bottom of the page, the very last bullet point. It's interesting that loans can be used by families to hedge against estate tax law changes. So loans are just that. They're not gifts. If they're structured appropriately, they're not going to create gift tax consequences. And while gift tax payments can be a smart strategy in a stable estate planning environment, when you don't have that, which is the environment that we're in now, paying gift tax is generally not considered a great idea. Loans can be used to basically hedge against future estate tax law changes. Loans also form the bedrock for many of the most aggressive estate planning techniques. Estate freeze techniques like installment sales depend on loans for financing the purchase of discounted assets. Another common use that we see being used is split dollar loans in the life insurance context. And then increasingly, Cummings and Lockwood lawyers are getting calls about more exotic loan techniques like self-canceling installment notes or skins. And these are really limited to clients who have used all of their estate tax exemption, first of all, and have very strong stomachs because the IRS hates these things and will try to unwind the planning that you do and turn what was a loan into a gift. It's important to know that for your clients to have all of the benefits of loans, you need to administer loans properly. So this next portion of the presentation will talk about some of the administration issues that come up. Loans and any transfer of property between family members, the presumption is that it's a gift. So your job when you're structuring the loan is to try to make this a transfer for full and adequate consideration so that it becomes not a gift and a true loan. The IRS does have codified loan requirements in the corporate context, but these are, simple and applicable to intra-family contexts as well. So one of the obligations when you're structuring a loan is that your client has to have an unconditional obligation to pay. The lender must also have typical creditor rights, such as the right to trigger default. The borrower must be able to repay the loan when you make the loan. If they can't possibly repay the loan with their own assets, then the IRS could come in and say that this was not a bona fide loan. There actually has to be transfer of money from the borrower back to the lender in the form of interest payments and principal payments. And finally, if there's a default under the loan, the lender actually has to take action to recover the loan proceeds, like a typical lender would. Our job is to make sure that these loans are documented properly. So, if we skip to the second bullet here, what we're trying to do is make sure that the loans are bona fide indebtedness. Those are the elements on the previous slide. We have to administer the loan properly, and we have to use the appropriate interest rate. And if we do that, then we avoid the mess that is on the next 3 slides, which is the below market loan regime, which is totally unnecessary for your clients to get into, creates all kinds of issues with imputed interest, potential imputed gifts, and an accounting nightmare for all of the CPAs in the audience. So we try to structure our loans to avoid this entire regime. If you look at below market loan regimes, there's 2 types of loans, demand loans and term loans. Typically, we try to move our clients towards doing term loans. There are some cases where your client may insist that they want a demand loan in different circumstances. But this is an example of the calculations that you may have to do if you fall into a demand loan below market regime. And this slide is horrible. I hate it. It's complicated, and it's in here really to scare you. So what you want to do instead of getting into this is call your Cummings & Lockwood lawyer and have them structure a term loan, which is on slide 103. But there is one tip for demand loans to make them a little more simple. That's on 102. Demand loans float in terms of the interest rate that's required. The tip that I've described here is basically for loans that are not, in the multi-million-dollar range, the amount that you're having to spend to administer it may not be worth the trouble of trying to use the lowest AFR possible. Instead, you can just simply pick an interest rate that is 25 or 50 basis points above the AFR and hope that the AFR doesn't rise above that interest rate during the term of the loan. So what we typically do are term loans. They're extremely simple. You pick a term. Generally, it's a term of years. Sometimes you can have more exotic loans where they're tied to the life expectancy of the lender in an insurance context, split dollar loan. But generally, they're just a term of years. The AFR is very simple to apply. You have 3 years or less for short-term loans, 3 to 9 years for a midterm loan, and then over 9 years for a long-term loan. There are some traps for the unwary. If you do not have the requirement to pay interest during the term of the loan, and you're allowed to accrue interest, and you have separate taxpayers, meaning you're not doing a loan between a grantor trust and the grantor, you can actually have imputed interest through original issue discount rules. But one of the reasons we've said, in my first example, that loans can be so powerful is oftentimes we structure these through grantor trusts. And that allows you to basically avoid all of the complications of having term loans with potential issues. So if we flip to loans to grantor trust, we'll spend a little bit of time on that. It's very simple. So loans are as simple to grantor trust as transferring money from your right pocket, so I have an Abraham Lincoln here, to transfer it into your left pocket. At the end of the loan term, take it out, pay me interest, comes back. My left pocket has the appreciation. And if any of the investment advisors in this room were investing, we'd have an extra dollar that the left pocket gets to keep. The good thing about this is that all of what you just saw doesn't happen from the IRS's perspective. There is no change in the dollars going back and forth. It's completely disregarded from the IRS's perspective. Any of the appreciation and the income taxes on potential sales of the appreciation are taxed to me, and that's an additional gift to the trust. For those benefits to actually accrue to your client, you do have to administer these loans properly. So the last slide will just review the top 5 loan best practices. Top 10 lists were 2016 if you came to our presentation last year. So we're going to do top 5 this year. Number 5, cover your bases. Have a signed and dated promissory note. Lend to a borrower with adequate resources to repay, and use the appropriate AFR. Number 4, repay the interest on time. Repay the loan when due, including all principal. Follow any note penalty provisions. If your client does miss an interest payment, which does happen, just follow the penalty provision that's in the note. Avoid extending or refinancing loans at the end of the term. Especially avoid doing that repeatedly. So if you're basically never paying the principal and you're just continuing to roll the note forward, it's going to look more like a gift transaction to the IRS than debt. Number 3, use collateral where appropriate. There's nothing that looks, more bona fide indebtedness from the IRS's perspective than if you actually have a security interest that you can foreclose on. If you're doing this in the real estate context, you may also be able to avail yourself of the mortgage interest deduction for so long as we have it. Number 2, use term loans instead of demand loans, and for larger amounts, make them to the grantor trust in order to increase the benefits to your clients. And lastly, just don't get cute. So everybody in this room is very smart, but don't try to outsmart the IRS and get greedy. So doing something like a 50-year loan that has 2% interest is not going to look like debt to the IRS. Keep it reasonable. Require at least interest-only payments every year. So formerly we used to do balloon payments a lot, and you still see those in the estate planning context, and they can be right for clients. But there's increasing case law challenging situations where, especially elderly clients, are deferring the requirement of receiving interest for a period of time that may exceed their life expectancy. The IRS hates that, and they attack it, so we'd recommend not doing it for most of your clients. So if you administer it properly, your clients will have the benefit of a very efficient and powerful estate planning strategy. Thank you.